Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Hello, everyone, and welcome to the Skeptic's Guide to Investing. I'm Steve Davenport, and I'm here with Clem Miller, and we're going to talk to you about the Fed and the decisions yesterday to lower rates and to give us a little bit of a surprise. The Fed is usually very transparent, and everybody understands what they're going to do for the next 2 or 3 meetings. But yesterday, they gave us a little bit of a curveball. What do you think about what the Fed said yesterday regarding December not being exactly what the administration and a lot of the market wants, which is another rate cut? I thought the Fed left everything in the hands of the administration to tell them what to do and when to do it. Is that not the way it's working, Clem?
No, and I think that in this case, they're trying to temper all those economists who think they're going to be like 6 rate cuts in a row or 5 rate cuts in a row. The Fed is saying no, that's not necessarily the case. It could be just one now and then a gap and then another, in a couple of, sort of early to mid 2026, and then maybe one later 2026. They're not obeisant to the president, and they're not trying to do what the economists are saying. They're not following the leads of the private sector economists. I think if anybody was thrown a curveball, it was the macroeconomists who were pretty convinced that we were going to see a round of several rounds of rate cuts. Now, it's worth noting, why did these economists think there would be rounds of rate cuts? Because they see the economy starting to weaken. And apparently the Fed is not 100% convinced of that. They look at some recent weak data, of course, they mentioned that, but is there going to be more weak data? They're waiting to see what the data actually looks like. And right now, the government isn't producing much data because you've got this government shutdown that affects the statisticians. And even on top of that, you have this, this uncertainty about the accuracy of the data that's coming out of BLS. The one guy they nominated, the Heritage Foundation economist, so to speak, who was nominated to be the head of BLS, he had to withdraw because he was seen to be too extreme. So it's a good thing he wasn't nominated, because then you'd really have to question the data a lot. But I think you still have to, under the Trump administration, now that they've identified BLS as a source of their angst, I think one has to question, the accuracy of that data going forward. So
I think that, I hate to say this because I know that it's a little bit of heresy for anybody in this business to question rate cuts, because rate cuts are good for market values and everybody wants higher market values, right? We all want, as a society, to see the markets continue to go up and to the right. And I do too, but I also don't know if the Fed should be sitting on this position of always trying to satisfy markets. I thought that their original goal was to help the economy and unemployment and lower inflation. And if there is a third, I think the markets are a tertiary or more goal. So I don't think, the entire population is not in the market. So I don't know how you can say we're helping the American people by helping the markets. We're helping the people who have a lot of equities. So I have a little problem with if the data is not there, and if they're having trouble with data and it's making them uncertain, they made a pretty quick vote to lower rates, and they haven't had data for a while. So I'm not sure I'm buying into the whole, we're doing this because of the data. I kind of wonder if they're doing this as a statement to the administration that we will not be influenced by what you want. We're still here to defend the dollar and some of the things that are important to the economy. I mean, could they be? It seemed like Powell caved quickly in before the September meeting and his Jackson Hole speech, and seemed to be entirely on board with what the administration wanted. And now he seems to be stepping it back. Is this about a power struggle, or is this really about the data, Glenn?
Well, it's about data. Plus, I think it's a little bit about.
But they haven't had data. The
Right.
government.
I know. It's the absence of data. It's the absence of data.
But
That's
they
the issue.
cut. My point is that they made a cut yesterday, and they didn't have data.
Yeah.
Talking about in the
Right.
future. Well, if they don't have data and they're thinking there's a problem, then it was a problem yesterday, wasn't it?
Yeah. They're living off the old data, basically, Steve.
But you just told me that you think the old
Yeah,
data
but
is questionable. So
well, no,
I
the
guess I
old data.
don't
Okay,
understand.
as
Is
time
it
goes,
really
as
data?
time goes, as time goes on, and the lack of data gets to be a compounding problem, right? Then there's less certainty about what's going on with the data. So it's not a problem where if the data is shut off, you are completely unable to make decisions. It's a compounding problem where a month from now, the fact that there's no data is going to be worse than it is now. In 2 months, it's going to be worse than it is now. 3 months, even more worse. So that's the issue on that. But back to your latest question about whether this is a power struggle or not. I agree with you that what they're trying to do is they're trying to emphasize Fed independence. I really think that's an important part of what they are doing. I think that they see that the administration is somewhat distracted by some other things, and so now,
I like the word fickle. You ever heard the
yeah,
word fickle? I think that kind
yes,
of describes, I would say on Friday they're one thing towards China, and on Monday it's like the sun has come out and everything is glorious in China again. So
yeah,
I call that
and
fickle.
so and so it's a perfect opportunity to sort of get in a statement about Fed independence when there's so much else going on. Of course, Trump might look at that and say, well, you were trying to undermine my trip with Xi out in Korea. So, maybe there'll be some kind of true social out of the White House on that, but but we'll see. In any
Yeah,
case, the market, I was looking at it this morning and looking at it now, I bet you the market's down. Let me see. Oh, actually yeah,
yeah.
market's down. Market's down. I'm up. Market's down.
I forgot this episode is all about you and how the Fed
I
affects.
like I like
Cloud.
I like I like when I'm up and the market's down.
All
So
right.
so
Can we think about the investors that listen to the podcast and stop talking about you and your net worth?
um
I
so
have an important question, Clem, that we don't really get to.
well,
We talk
wait a
about.
minute, wait a minute. You hold your question for a second. I just wanted to mention one thing, and that is I think that one of the reasons why the Fed is being a little bit uh uh not wanting to talk about another rate cut yet is because the Supreme Court is going to be talking about going to have oral arguments on the tariffs in a couple of weeks. And I think they're going to want to see how that goes. Because if it looks like, based on the conversation at the Supreme Court, that Trump's tariffs are going to get overturned, that creates a different economic scenario than if it looks like the Supreme Court is going to uphold them in some sense. I still believe that the Supreme Court is going to overturn them. For the most part, I think there are certain areas that they can that they may make some, I don't know, exceptions or reinforce some older laws. Like, for example, the steel and aluminum, that's actually allowed under law to have the president apply those tariffs, without having to go back to Congress. But uh, some other things, these new reciprocal quote unquote tariffs, the fentanyl quote unquote tariffs, all those things are kind of new things that depend on the willingness of the Supreme Court to allow emergency powers along the lines of economic sanctions to apply to tariffs, when tariffs have always been about collecting revenue and about leveling the playing field competitively. So I still don't think they're going to agree to that. I think if the Fed sees a conversation that goes against tariffs, I think that might actually be positive. I know Trump would say, "Oh, it's so negative that the Supreme Court's turning them down." I don't think so. I think it's going to be a positive for the economy if the Supreme Court does that, and I think that that will
Yeah, that
influence.
would obviate the need for another cut, I think.
Yes.
And so I think it's, I think there's so many things that can go on between now and the December meeting that I think a little bit what Powell is doing is just putting a defensive statement out there when he controls the message, which at the press conference, that's what he's supposed to do. He's supposed to be clarifying and making things more understandable so that the Fed's not doing something that will surprise. And I think by saying this, he's setting the groundwork for, the fact that, hey, there is a lot of uncertainty. And I honestly, do you think, I think there's issues of the shutdown, there's issues of China, there's issues of Supreme Court and tariffs. There's a lot of issues going around, but I thought we could kind of segue for a moment into the idea of what do they really mean when they say rates are coming down, therefore it helps businesses, it helps individuals with home mortgages, and why that might not necessarily be the case. The simple assumption that everybody's making is if the Fed thinks about the curve, and we talk about the interest rate curve, and really what it is what are interest rates across different durations? And duration we mean time. So the short-term rate, the 3-month, the 9-month, the T-bills, the 1 year, the 3 year, the 5 year, which is where a lot of businesses borrow, and then the 10 year, which is key for mortgage rates. We're making, or the market and the media is making the assumption that a quarter point cut in the short end is going to mean a quarter point across the 1 year, the 3 year, the 5 year, the 10 year, and the 20 year. That it all shifts in one big move, and it's all consistent across each duration. And I think you and I know that's simply not true. That doesn't happen exactly. It's a lot more complicated based on supply and demand and what Treasury issuance is going to be and what different pensions and insurance companies need in terms of duration. So there's other variables, and it's not as simple as Fed cut equals lower rate for everyone. And I think I think this is another case of the attention span of the average investor being shorter, and everybody wants to explain to me, well, what does the Fed matter? Okay, I'll tell you, low rate, good for market. And I think it's a little bit I don't know, insulting.
Right. That's
or-
not what you're saying is that's not the end of the story. You know,
Correct. I think it's, I think it's, I think it's an attempt by the Fed to do something, but it is far from, it's far from absolute control over the curve. They control
so
the short rate. That's it.
let me reinforce again for those who may not really understand interest rates and rate curves is that, as Steve was saying, there are multiple types of rates by term, and the Fed only controls the short-term rates. Okay, they only control the short-term rates. They do not control the long-term rates, which are determined by the bond market. And while short-term rate changes can have some influence on the bond market and on longer-term yields, longer-term rates, those influences can be quite modest. And really, there would be the greater driver on bond markets is really long-term inflation expectations. So if it's expected, if you've got a situation where tariffs continue and inflation is expected to rise, this would have an impact on making bond yields go up. And obviously bond prices go down, but bond yields go up, which would be, as Steve was pointing out, bad for mortgages and other long-term debt instruments. Also, to the extent that stock investors look at bond yields as a discounting factor for long-term cash flows, it's actually not that great for the stock market either. At least some elements of the stock market.
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
Right. I guess I'd say to people is our name is Skeptics Guide. And the reason we picked that name is that we think sometimes you need to be a little skeptical about what the media is saying and what people are talking about regarding your portfolio and your assets. And sometimes, and I don't mean to be cynical with this comment, but sometimes these people are talking their own book. And in market terms, that means they're saying what they want to affect their business and their stock and their particular choices. And so they're saying, I'm all in on this market because the Fed's cutting rates. Fed cutting rates means, it's good for me. And I think it's a little bit simplistic and a little bit almost insulting to investors because we know that
It's marketing.
That's not really true. We know that it's a complicated decision that involves a lot of variables and a lot of things that we don't have any control over. We're trying to come up with whether we think this is a good thing or a bad thing for markets. And in general, I guess
Right.
I would say right now it's good, but I think what they're saying is it really could change and we could really see many things happen between now and the December meeting that would indicate a reason
Right.
to not cut. And if they don't cut, then none of the shifting goes on because it's just not likely to happen. And I think that
Right.
I guess I would say to everyone, if you hear something that sounds too simple or too good, it probably is. And I don't
Right.
think this rally on AI can go on forever. And we're going to do another
Well, that can't either. We'll be talking about that one in a moment, but
Yeah,
I just wanted to
is our next
on the Fed issue. Back on Fed before we conclude this. there's this impression that's often communicated on media like CNBC or other media, or by investment firms, economists, what have you, that the Fed is some kind of all-seeing, all-knowing, all-powerful kind of guru, okay, running the economy, sort of. But if you remember the movie The Wizard of Oz, okay, and
Love
you
the
remember the
Wizard of Oz
scene,
analogies.
with the wizard trying to drive all the
I agree. It's not a yellow brick road. There's a lot of things on the side of the road. And I like to think of some of the people involved in the current economic discussion as the Tin Man with no, the Tin Man has no heart, and who is the Scarecrow has no brain. And so there are people with very little brains and very little heart and very little courage that we see in today's market. And we could probably do an episode on just who are the analogies. And I think Powell would be, the wizard. And I think that, I don't know,
Yeah.
you want to go through who the characters are and who maybe make some analogies to, that's probably not a good idea. We're probably stepping into an area that has a lot of risk here. But anyway, the bottom line for us in the Fed is that there are some people with lack of courage, and there are some people with lack of brain, and there are some people with lack of heart who are deeply engaged in this discussion. And so it's not perfect. The Fed is not all knowing, and the Fed, likes to say that occasionally at the end of the press conference, but they also like to say, we have this responsibility and we take it seriously. And I think that they do to a great degree. But I think that when we're talking about the Fed, I'd like to kind of go to what's happening with it looks like Cook is not going to be taken off the Fed. It looks like the Fed is having meetings in January. The end of January, there will be votes on who should be in nominations or who will be the regional presidents of the different Fed banks. And that meeting and those nominations, Trump and the administration wanted to have more people on the Fed committee so that they could vote for more of the candidates that they think would be good in those roles. And ultimately, people in those roles rotate in onto the committee. So it would be kind of stacking the deck, if you wish, to more people who would be more aligned to the administration's low rates. Now, I think that we have this image of everything working the most qualified people will get nominated, and therefore we fill our committees with the best people. I think we have to step back now and say, we know that there's politics in everything. There's politics in every bill. Every person who gets on CNBC has an agenda. Those agendas may not align with yours. So if you're waiting for, the Fed to lower in order to buy a house, if you're waiting for the Fed to lower to make another investment in more NVIDIA, let's look at this reasonably and say, maybe we should look at what happens if they don't lower and how that would affect the markets and how it would affect the overall economy. I think there's too many variables right now to say that lowering or raising rates right now would squash the economy and or make it unbelievably riskless. Those things don't happen. And so the
I agree.
media.
I agree. And one last thing, Steve. I agree. And one last thing, as you mentioned that, not about expectations and about really not getting your expectations up in advance of a decision. A lot of people are also making decisions about what could happen in the future. And so you're not just making a bet on what the Fed would do. You're making a bet on against people who are also making the same decisions right now.
Right.
So it's all about It's all about competing against others in the market.
Right. And you're trying to do things that are right for you. That's where, the center of your plan, the center of your investments should always be, how does this affect me? And how do I make the changes I need so that my assets are working the way I want them to, in the direction, whether it's income or whether it's growth or whether it's international or whether it's private. All of these decisions come down to, how is it going to affect me? And if the Fed doesn't change, how does that affect me? I think that we need to step back and stop the Fed mania. We're not in a place where the world is on an edge, on a knife edge, and it'll tilt one way if the Fed doesn't lower. It's not that simple. And I think that for what that really means to you is, hey, it's complicated. And therefore, I need to get back into my core and understand what I need in order to come up with the right decision based on all these other market factors. And so I guess I would say to people, invest with your interests at heart and look at yourself and your investments as, I have a chance to do some things that are going to help me improve my lifestyle and my overall financial wellness. And that's what we're here for at Skeptics Guide. And I think that putting your head, turning away from the TV when they tell you that the Fed is, critical in how you're going to live your life, I think it's a little bit overblown. And I would ask people to step back from Fed mania and focus on the fundamentals of your portfolio and the fundamentals of what you want to do with your money. Anything else, Glenn?
1,000%. Nope, I agree with you 1,000%.
So take care out there. And as they used to say on the police show there, be careful out there. It could get dangerous. So I hope people enjoy the podcast and share it with their friends. Do you have any last thoughts, Clem?
No, just just be mindful that there's no real Wizard of Oz out there.
All right, and we're going to work on our Wizard of Oz analogies and come back to you with maybe a separate podcast just on movies and characters and who we think the current people in the administration and others were best captured on the silver screen. So thanks everybody for listening. We enjoyed talking to you. Please let us know topics and ideas that we should be sharing, and just have a great day.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.